It's 2024, and Sarah, a software developer from Austin, stumbles upon something called Bittensor subnet tokens while browsing crypto Twitter at 2 a.m. Like many of us, she's heard the AI hype but never understood how regular people could actually invest in this revolution. Sound familiar? Well, Sarah's journey into subnet tokens is probably a lot like yours might be. She started with confusion, moved through excitement, faced some hard truths, and eventually learned to navigate this wild new world of AI-powered crypto tokens. Today, I'm going to tell you Sarah's story, and through it, explain everything you need to know about subnet token valuation. We'll follow her from complete beginner to informed investor, learning the same lessons she did along the way. By the end, you'll understand not just what these tokens are, but how to think about them like Sarah does now, with knowledge, caution, and just the right amount of optimism. Plus, I'll share that Unsupervised Capital article that helped Sarah level up her analysis game. Sarah's first question was obvious. So, these subnet tokens are like Bitcoin, right? Wrong. And this confusion nearly cost her money. Here's how Sarah learned the difference. Bitcoin, she discovered, is like owning digital gold. You buy it, hold it, and hope more people want it. Simple. The value comes from scarcity and network effects. Basic supply and demand economics that even her grandmother could understand. But subnet tokens? That's a completely different story. Sarah realized she was unbuying digital gold. She was buying shares in AI companies that don't quite exist yet. Each token represents ownership in a network of computers working together to provide AI services. The light bulb moment came when Sarah's friend Jake, a data scientist, explained it this way. Imagine if Netflix wasn't one company, but thousands of computers around the world working together to recommend movies. And imagine you could buy a piece of that network. Suddenly, it clicked. Sarah learned that while Bitcoin just sits there being scarce, subnet tokens need their underlying AI networks to actually succeed as businesses. If people don't use the AI services, the token becomes worthless. It's like owning stock in a restaurant. If nobody eats there, your investment goes to zero. The staking mechanism confused Sarah at first. With Bitcoin, you just hold it. With subnet tokens, you can stake them to earn rewards, but you're essentially betting on the network's performance. Sarah realized this was more like being an investor operator than a passive holder. The governance aspect was another eye-opener. Bitcoin never changes much. It's designed to be stable, but subnet token holders actually vote on network changes. Sarah found herself having opinions about AI model parameters and tokenomics, stuff she never thought she'd care about. Sarah's first attempt at valuing subnet tokens was optimistic. She looked at the AI market size, picked a random subnet, assumed it would capture 1% of that market, and calculated the token should be worth 10x current prices. She was about to put her savings in when her mentor, experienced investor Maria, intervened. Sarah, Maria said, you're making the classic beginner mistake. You're valuing the dream, not the reality. Maria taught Sarah to ask harder questions. Who's actually using this network? How much are they paying? Is the token even necessary for the network to function? Sarah learned her first real valuation method. The restaurant test. If the subnet is like a restaurant, how many customers does it serve daily? How much do they pay per meal? Are customers coming back? Most subnet tokens, Sarah discovered, represented restaurants with beautiful websites but empty dining rooms. The second method Maria taught was the competition check. Sarah learned to research what established AI companies were charging for similar services. If OpenAI charges $20 per million tokens for language processing, and a subnet offers the same service, the subnet's total possible revenue is limited by that benchmark. Sarah's third lesson was about token velocity. a concept that blew her mind. Even if the subnet network became hugely successful, that didn't automatically make the token valuable. If tokens just pass through the system quickly, they might not hold value. It's like trying to value a highway by how many cars drive on it. Lots of activity doesn't mean the highway itself is valuable. The skin in the game analysis became Sarah's favorite tool. She learned to check if the team behind a subnet actually held significant tokens themselves. If the founders sold all their tokens immediately, that was a red flag. But if they had locked tokens for years, they were betting on long-term success. Maria also taught Sarah about network effects, but warned her they're weaker in AI than in social media. Unlike Facebook, where more users make the platform better for everyone, AI networks face commoditization pressure. Better models can emerge overnight, making existing networks obsolete. Sarah almost fell into the classic subnet token trap. Chasing yield. She found tokens offering 80% APY, and her eyes turned into dollar signs. Fortunately, Maria was there to save her again. "Sarah, where do you think that 80% comes from?" Maria asked. This question changed everything. Sarah learned to trace yield sources like a detective. She discovered most high APY came from printing new tokens, essentially paying existing holders with inflation. It was like a company paying dividends by issuing new shares. The sustainable yield lesson was painful but valuable. Sarah found only a handful of subnets, with yield backed by actual revenue from real customers. Most were just Ponzi-like structures where early stakers got paid with money from later stakers. Sarah experienced her first yield farming death spiral secondhand through her friend Mike. Mike chased a 120% APY subnet token. Watched his token count increase daily, felt rich for 2 weeks. Then watched the token price crash 90% as farmers dumped their rewards. Mike had more tokens but less total value. An expensive lesson in inflation dynamics. The lockup dilemma taught Sarah about opportunity costs. High yields often required locking tokens for months or years. Sarah learned to ask, "What else could I do with this money?" Sometimes a 30% APY with a 1-year lockup was worse than an 8% APY with monthly withdrawal options, especially in volatile markets. Sarah developed her grandmother test for APY sustainability. I explained to my grandmother where this yield comes from without using the words tokenomics or emissions. If not, the yield was probably unsustainable. 6 months into her subnet token journey, Sarah had her first major wake-up call. The token she'd researched most carefully. One with real users, sustainable tokenomics, and a great team, dropped 60% during a market correction. This taught Sarah that even good subnet tokens were still speculative tech investments subject to crypto market cycles. Her diversified approach probably saved her from bigger losses, but it was still painful. Sarah noticed something troubling. Tokens with similar market caps but vastly different levels of actual usage and development. It was like seeing a food truck valued the same as a 5-star restaurant. The market clearly wasn't efficiently pricing these assets based on fundamentals. The regulatory scare of late 2024 hit Sarah's portfolio hard. When news broke about potential SEC enforcement actions against some subnet tokens, prices across the board crashed. Sarah learned that regulatory risk affected all tokens, regardless of their individual merits. But Sarah also witnessed the flip side. When a major subnet announced a partnership with Microsoft, its token pumped 300% in a week, lifting the entire sector. Sarah realized that positive developments in one part of the ecosystem could benefit her entire subnet token portfolio. The experience taught Sarah to think in probabilities, not certainties. She developed a mental model. Most subnet tokens will probably fail, but the ones that succeed could return 10 to 100x. I need to position size accordingly and not put all my eggs in one basket. Sarah's biggest lesson was emotional discipline. She learned to tune out the daily noise, focus on quarterly progress reports, and stick to her investment thesis. The hardest part wasn't analyzing tokens. It was managing her own psychology. A year later, Sarah reflects on her subnet token journey. She asks neither rich nor broke. Her careful approach and position. Sizing protected her from major losses while capturing some solid gains from her best picks. Her advice to new subnet token investors: start small, learn fast, and don't let FOMO drive your decisions. Treat these like startup investments, not crypto trades. Most will fail, but position yourself to benefit from the few that succeed. Sarah's portfolio now includes 3 subnet tokens. She considers core holdings tokens with real usage, sustainable economics, and strong teams. She still holds some moonshot positions in promising early-stage projects, but never more than she can afford to lose completely. Her biggest regret: not reading that Unsupervised Capital article sooner. It would have saved her from several rookie mistakes and helped her develop better analytical frameworks earlier in her journey. Sarah's story isn't over. The subnet token space is still evolving rapidly, but she's now equipped with the knowledge, experience, and emotional discipline to navigate whatever comes next. What about you? Are you ready to start your own subnet token journey? Remember Sarah's lessons, do your own research, and maybe you'll have your own success story to tell. Thanks for following Sarah's adventure with me today.